Financial freedom, passive income, and positive cash flow are the ultimate goals in managing money and investing. These achievements can be the difference between a life constrained by a regular job and one that allows you the freedom to pursue your passions and interests. Imagine a life where your assets work for you, generating enough income to cover not just your necessities, but also your wants. Whether it's traditional investments like real estate and stocks, or less common options like intellectual property, each type of asset provides unique opportunities for creating wealth and ensuring long-term financial stability. It's widely known that wealthy individuals have various income sources and don't rely on just one. Successful individuals typically possess assets that generate income and contribute to long-term wealth. The question arises, what specific assets are currently playing a key role in making people wealthy? In today's video, we're uncovering the mysteries of building wealth by exploring 9 assets that could potentially contribute to your financial success. It's important to note that this isn't a recommendation for you to immediately invest in these assets. Instead, consider it a starting point for your own exploration. Since I don't have details about your unique situation, I can't determine which, if any, of these assets might be the right fit for you. Before we begin, let's take a moment to understand what we mean by assets. An asset, in financial terms, is essentially something you own that holds value and has the potential to generate income or appreciate over time. Creating a diverse portfolio of assets is a key strategy for accumulating wealth. According to Robert Kiyosaki, the author of the popular book Rich Dad, Poor Dad, an asset is an object, property, or any possession that puts money in your pocket, while a liability takes money out of your pocket. Wealthy people focus on acquiring assets and minimizing liabilities to grow their wealth. You see, wealth is not just about the money you earn, it's also about the assets you acquire. Assets are like seeds. You plant them, nurture them, and over time, they grow and bear fruits. They're the key to building and maintaining wealth. They could be physical like a house, or they could be financial like stocks or bonds. The beauty of these assets lies in their potential to increase in value over time, offering a consistent income stream or a lump sum when you decide to sell. Now, my friends, get ready to learn about some assets that have the potential to be your ticket to financial success. First on our list is real estate. But what exactly is it? Well, in the simplest terms, real estate refers to property, which includes land and buildings. Real estate has been a reliable method for wealth creation over the years, and there's a solid reason behind it. With a growing population, the demand for housing increases, offering various avenues to build wealth through real estate. One strategy involves renting out your property, allowing you to receive regular income without constant effort. This is known as passive income. The crucial factor is to invest in properties located in high-demand areas, enabling you to charge competitive rents. As you gradually pay off the mortgage, your equity and income potential also increase over time. Now, there are several types of real estate, each with its own set of opportunities for wealth creation. Let's begin with residential real estate. This includes properties like houses, apartments, townhouses, and vacation homes. Investing in residential real estate can lead to wealth through 2 main avenues: capital growth and rental income. Capital growth means the value of your property increases over time, and when you sell it, you earn a profit. Rental income, on the other hand, is the regular income you earn by renting out your property. Next, we have commercial real estate, which involves properties like office buildings, shopping centers, and hotels. This type of real estate often yields higher returns than residential real estate due to long-term leases and higher rental rates. Then there's industrial real estate. Think warehouses, factories, and distribution centers. These properties can provide a steady income stream, especially in areas with thriving industries. But it's not all sunshine and rainbows. With real estate, there are also costs and risks to consider. Maintenance costs, for instance, can eat into your profits. There's also the risk of market fluctuations. Property values can go down as well as up, and if you're not careful, you could find yourself selling at a loss. Another potential downside is the illiquid nature of real estate. Unlike stocks or bonds, you can't sell a property at the drop of a hat. It can take months, sometimes even years, to find a buyer at the right price. So, what's the takeaway? Investing in real estate can be a great way to build wealth, but remember to consider the risks and costs. It's not a decision to be taken lightly, and it's always wise to do your research and consult with professionals before taking the plunge. If real estate appeals to you, but you'd rather avoid the hassles of property management and logistics, a good alternative is a REIT or real estate investment trust. A REIT is a company that owns and manages real estate, and investors can buy shares in the company, earning dividends from its real estate ventures. Think of a real estate investment trust, REIT, like a stock. When you invest in a REIT, you're essentially buying a share of a company that owns and takes care of real estate properties. This company makes money from the properties, and they share those earnings with their investors as dividends. The cool part is that REITs can be bought and sold on major public exchanges, such as the New York Stock Exchange or the NASDAQ, making the buying process more straightforward. If you like the idea of having a stake in real estate but don't want the hassle of managing properties yourself, a REIT could be a good fit. It's a business that handles the ownership and management of real estate and shares the income from those properties with its owners. Next up, we have stocks. But what's a stock anyway? Let's break it down. When you buy a stock, you're essentially purchasing a tiny slice of a company. This piece of ownership is often referred to as a share. Stocks are a fabulous way of creating wealth because they offer two primary avenues for income. First, there are dividends. Dividends are the portion of a company's earnings that are distributed to shareholders. Owning stocks of a company that regularly pays dividends is like having an additional income stream. Many companies distribute part of the profits to owners every quarter. Investors who receive dividends get a check every quarter, in addition to the growth of their initial investment. They have the option to use this passive income for personal spending or reinvest it by purchasing more stocks. Reinvesting the cash flow enables them to compound their earnings, contributing to further growth over time. Second, there's something called capital gains. Let's say you buy a stock at $10 per share, and then the price shoots up to $15. If you sell at this point, the $5 difference per share is your capital gain. Even though investing in the stock market offers the potential for both long-term capital growth and the power compounding of gains. While the market can be volatile, a well-diversified portfolio of stocks can provide handsome returns over the long run. Wealth can be built over the long term in the stock market through either an investing system or a stock trading system, with an edge through the power of compounding capital gains. This is best done in a tax-deferred account to avoid taxes eating away at capital growth. Now, let's talk about the pros of investing in stocks. One of the biggest advantages is the potential for high returns. Over the long term, stocks have consistently provided higher returns compared to other asset classes. Also, stocks offer easy liquidity. This means that you can quickly convert your stocks into cash, which can be a lifesaver in case of a financial emergency. Importantly, stocks are appealing because they demand no continuous effort on your part. Once you own a share of a business, you get to enjoy the benefits while someone else manages the day-to-day operations. But hold your horses. Stocks are not all sunshine and rainbows. There are some cons to consider. The most glaring one is volatility. Stocks can be highly unpredictable, making them challenging to hold onto during periods of turbulence. It can be emotionally taxing to witness a decade's worth of growth vanish in just a few days, even for seasoned investors. What adds to the challenge is when these declines are driven more by changing investor sentiment than actual shifts in the fundamental strength of the businesses involved. Stock prices can experience significant drops in a short time frame, and you might wake up to find the value of your stocks has sharply decreased. This volatility introduces the risk of potential losses, emphasizing the importance of having a diversified portfolio to spread and mitigate risk. Dealing with emotional ups and downs in the stock market is best tackled by adopting a long-term perspective. Although it doesn't guarantee returns, historical evidence suggests that time tends to work in favor of stock investors, emphasizing the value of patience over the long haul. Also, investing in stocks requires a fair bit of knowledge and research. You need to understand the company's financial health, industry trends, and market conditions before you decide to buy its stocks. While stocks can offer high returns, they come with a certain level of risk. Always do your research before investing. After all, you wouldn't want to put your hard-earned money into something you don't fully understand, would you? Having explored the dynamic realm of stocks, let's now shift our focus to the more tranquil world of bonds. When the government or company needs to secure funding for a project, they may issue bonds for investors to purchase. It's essential to understand that a bond differs from a stock. While owning stock means having a small share of ownership in a company, which entails sharing in its gains or losses, a bond represents a debt that a company or government owes to investors. When you buy a bond, you are essentially lending money to the entity, and in return, they commit to paying back the principal amount with interest on a predetermined date. Bonds, in the simplest terms, are loans that you give to either companies or governments. In return, they promise to pay you back the borrowed amount, called the principal, after a certain period known as the maturity date. Plus, they sweeten the deal by paying you interest periodically throughout the loan's term. Sounds pretty straightforward, right? There are three main types of bonds: government, corporate, and municipal. Government bonds, also known as treasuries or gilts, are issued by the national government. These are considered the safest bonds because they're backed by the full faith and credit of the government. On the other hand, corporate bonds are issued by companies. These can offer higher interest rates, but come with a higher risk if the company isn't doing well. Lastly, municipal bonds are issued by local authorities or municipalities to finance public projects. These bonds often have tax advantages, which can be appealing to certain investors. So, how can bonds contribute to building wealth? Bonds offer a reliable income stream through interest payments. Unlike stocks and other high-risk assets, bonds exhibit lower volatility, providing a more stable and dependable performance, especially in times of economic uncertainty. Additionally, bonds are generally considered lower risk compared to stocks, making them a suitable choice for more conservative investors. Indeed, bonds are often viewed as safer investments compared to stocks. This is because owning stocks means holding a share of ownership in a company, and if the company's market value declines, stockholders can experience losses. On the other hand, bondholders who have provided loans to the company are less affected by fluctuations in market value. In some cases, bonds may even gain value because the company is still obligated to repay its debts regardless of its market performance. It's worth noting, though, that if a company goes bankrupt, bondholders still have a priority claim on the company's assets and are more likely to recover some of their investment compared to stockholders. But, as with every asset, bonds come with their own set of cons. For instance, they typically offer lower returns than riskier assets like stocks. This means that over the long term, you might end up with less wealth than if you had taken on a bit more risk. Additionally, bonds are vulnerable to inflation. If the inflation rate rises, the purchasing power of your interest payments could decrease, effectively lowering your real return. In a nutshell, bonds can be a safer investment option, but they may not offer the high returns that riskier assets do. Investors use bonds to diversify their investment portfolio and limit their total risk. They're a bit like the tortoise in the tortoise and the hare story, slow and steady, but not necessarily the fastest way to wealth. So, are bonds worth your time? Well, that depends on your investment goals, risk tolerance, and time horizon. Next, we have certificates of deposit and money market funds. But how can they make you rich? Let's dive into it, shall we? Certificates of deposit, CDEs, and money market funds are both low-risk investment options that can provide a steady income stream for investors. CDs are time deposit accounts offered by banks and credit unions. When you purchase a CD, you agree to leave your money with the financial institution for a set period of time, such as 6 months, 1 year, or 5 years. In return, you receive a fixed interest rate that is typically higher than what you would earn on a savings account. At the end of the CD's term, you receive your initial investment plus any accrued interest. Money market funds, on the other hand, are mutual funds that invest in short-term debt securities, such as government bonds and commercial paper. These funds aim to provide investors with a stable value of $1 per share, which makes them an attractive option for those looking for a low-risk, short-term investment. With money market funds, you typically have easier access to your money than with CDs or other fixed income products. As a result, money market funds typically offer lower yields than CDs, but higher yields than traditional savings accounts. In summary, CDs and money market funds can be a good option for investors who want to earn a steady income stream while minimizing their risk. It's important to note that these investments typically offer lower returns than many of the other income-producing assets on this list. Building wealth through business ownership can be highly rewarding. Consider owning a small business or investing in one, which is where concepts like angel investing and small business investing come into play. However, before diving in, you need to decide whether you want to actively run the business or simply provide investment capital and expertise. If you opt to be an owner-operator of a small business or franchise, be prepared for the fact that the amount of work involved may surpass your initial expectations. While owning and operating a small business has the potential for higher returns compared to many other income-producing assets, it requires substantial effort and dedication to reap those rewards. Engaging in a business not only offers the potential for income through its operations, but also provides an opportunity for the business itself to appreciate as an asset. While starting and growing a business typically involves significant effort and is not inherently a passive income source, there's potential to systemize and automate aspects of the business, transforming it into a more passive income-generating asset when managed effectively. If you prefer not to take the hands-on operator role, being an angel investor or passive owner in a small business can yield substantial returns. However, before making a full commitment, it's crucial to recognize that small business investing demands a significant time commitment. The most successful small business investors contribute more than just money. They invest time and expertise. Therefore, if you're considering becoming a small business investor, be prepared for the possibility of making significant lifestyle adjustments to truly see substantial results. It often involves more than just providing capital. Active involvement and commitment are key factors in achieving success in this realm. Intellectual property, encompassing patents, copyrights, and trademarks, can serve as a source of passive income. Once you've created a valuable intellectual asset, such as a book, software, or catchy jingle, you can license it to others and receive royalties. The key is to develop something unique and valuable, legally protect it, and then offer licenses to others. If you have an invention with potential profitability, filing for a patent safeguards your invention, and companies may need to pay you for its use, whether it's an idea, a product, or software. Licensing your patent to companies allows you to earn residual income if your invention has marketable value. Trademarks, on the other hand, protect properties like logos, names, and phrases. Many well-known catchphrases are trademarked, and owners can generate income by licensing the use of these trademarks to others. Investing in your own products can be one of the most effective ways to generate income. Unlike the other assets mentioned, creating and selling your products, whether digital or physical, provides a level of control that is often unmatched in other asset classes. As the sole owner of your products, you have the authority to set the price, giving you the ability to determine the potential returns, at least in theory. Products can take various forms, such as books or ebooks, information guides, online courses, and more. Many individuals have successfully earned substantial incomes, ranging from 5 to 6 figures, by selling their products online. What's noteworthy is that if you already have an audience through social media, an email list, or a website, selling products becomes a viable way to monetize that audience. Even if you don't have an established distribution channel, platforms like Shopify and online payment processors have made it easier than ever to sell products online. Investing in products can be challenging because they demand significant upfront effort with no guaranteed immediate returns. As we've discussed before, many endeavors, including side hustles and product creation, often involve a lengthy journey to monetization. However, the upside is that once you have a successful product, it becomes considerably easier to build on that success. Having one lucrative product serves as a foundation for expanding your brand and diversifying your offerings. Last but not least, consider social media brands and audiences. This is a relatively recent phenomenon that many didn't take seriously a few years ago. However, as influencers started earning as much as A-list celebrities, the significance became apparent. Now, even traditional celebrities are transitioning into social media influencers. The power of social media lies not just in its wide reach, but also in the profound relationships that can be established on these platforms, which adds significant value. One of the best aspects of social media is its accessibility. There's no entry barrier. Anyone can leverage these platforms to build successful businesses. With just a phone camera, individuals can start creating income-generating assets through social media. So there you have it. These are some assets that can make you rich. Each asset has its pros and cons, and their potential for wealth creation varies greatly. It's crucial to remember that diversification is key to mitigating risk. Investing in different assets can help cushion any financial blows. Moreover, don't forget the importance of doing your own research. Understanding your investments is the first step to financial success. Always bear in mind that wealth creation involves risk management. Remember, there's no one-size-fits-all approach to wealth creation. Find the assets that work best for you and your financial goals. If you're not happy with where you're at, do something about it. Learn deeply about the assets and investment that you are interested in before you jump into it. Recognize the need for change, and then go ahead and make it happen. With patience, persistence, and risk management, you can achieve financial goals. Then, what steps are you taking to improve your financial situation? Share your thoughts, experiences, or questions in the comments below. Your insights might inspire someone else on their journey. Together, we can learn and grow. Thank you for joining us today. Look forward to seeing you in the next video.